Stock market crashes are often viewed as the ultimate nightmare for investors, evoking panic and a sense of financial doom. However, history shows us that these tumultuous periods can be more than just cautionary tales. They are invaluable learning opportunities. By understanding the patterns, emotions, and strategies surrounding market crashes, we can become better, more resilient investors. Whether you're a seasoned investor or someone dipping their toes into the stock market, the lessons learned from these downturns are universal and transformative. Crashes are inevitable, but why? To truly understand market crashes, we need to accept one fundamental truth. Stock markets move in cycles. Just as economies experience booms and busts, so do financial markets. These cycles are driven by factors such as investor sentiment, economic data, and external shocks. A perfect example is the dot-com bubble of the early 2000s, fueled by hype around internet companies. As investors piled into speculative tech stocks, prices soared. When reality failed to meet expectations, the bubble burst, wiping out trillions of dollars in market value. The takeaway here is that no market rises forever. By recognizing this inherent volatility, investors can prepare for downturns without succumbing to fear. Legendary investor Sir John Templeton famously said, "The four most dangerous words in investing are, 'This time, it's different.'" This quote reminds us that while the specifics of each crash may vary, the underlying patterns remain consistent. Markets correct themselves when they become overheated, and those who understand this cyclical nature are less likely to make rash decisions during a downturn. Panic leads to poor decisions. One of the most critical lessons from stock market crashes is the impact of investor psychology. When markets plummet, fear takes over. Panic selling becomes widespread as people rush to cut their losses, often locking in significant financial damage. This phenomenon was particularly evident during the 2008 financial crisis, when global markets plunged following the collapse of Lehman Brothers. Many investors, spooked by the uncertainty, sold their holdings at the bottom, missing out on the eventual recovery. On the other hand, seasoned investors often use crashes to their advantage. Warren Buffett's mantra, "Be fearful when others are greedy and greedy when others are fearful," encapsulates this contrarian approach. Instead of panicking, these investors view downturns as buying opportunities. For example, during the COVID-19 crash in March 2020, those who remained calm and invested in quality stocks at discounted prices saw substantial gains as the market rebounded. The key is to avoid making emotional decisions. Investing should be guided by a well-thought-out plan rather than reactions to market noise. Remember, the stock market is a tool for transferring wealth from the impatient to the patient, as Buffett wisely noted, the ultimate risk management tool. Another lesson from market crashes is the importance of diversification. During the financial crises of 2008 and 2020, portfolios heavily concentrated in specific sectors suffered catastrophic losses. For example, investors who had most of their wealth tied up in real estate or financial stocks during the 2008 crash faced significant setbacks as those sectors bore the brunt of the collapse. A diversified portfolio, on the other hand, spreads risk across various asset classes, industries, and geographical regions. This approach ensures that a downturn in one area does not derail your entire investment strategy. ETFs and index funds are excellent tools for achieving diversification without the need for constant monitoring of individual stocks. For example, during the COVID-19 crash, technology stocks like Amazon and Microsoft held up relatively well compared to energy stocks. A well-diversified portfolio containing a mix of these assets would have mitigated losses more effectively than one focused solely on energy or travel companies. Timing. The market One of the most common mistakes during market crashes is attempting to time the market. Many investors believe they can predict when the market will hit rock bottom and re-enter at the perfect moment. However, history has shown that even experts struggle with this feat. Missing just a few of the market's best-performing days can significantly impact long-term returns. Instead of trying to time the market, focus on time in the market. Consistently investing, regardless of market conditions, allows you to benefit from dollar-cost averaging. This strategy smooths out the impact of volatility and ensures that you are not overexposed to high prices or underinvested during recoveries. Consider this example: an investor who stayed invested during the 2008 crash and continued to contribute regularly to their portfolio would have benefited from the bull market that followed. In contrast, someone who pulled out their investments and waited for certainty likely missed out on significant gains. Crashes are not the end. Perhaps the most reassuring lesson from stock market crashes is that they are not the end of the world. Every major crash in history has been followed by a recovery. The Great Depression of the 1930s, the 1987 Black Monday crash, the dot-com bubble, and the 2008 financial crisis all seemed insurmountable at the time. Yet, in each case, the market eventually rebounded, often reaching new highs. This resilience underscores the importance of maintaining a long-term perspective. Short-term volatility is an inevitable part of investing, but it should not overshadow the potential for long-term growth. By focusing on your financial goals and sticking to your investment plan, you can weather even the most severe downturns. Financial experts highlight the importance of understanding historical crashes to build confidence during turbulent times. He emphasizes that knowledge of past events can help investors stay calm and make rational decisions when faced with uncertainty. Stock market crashes, while daunting, are invaluable for shaping a smarter investment strategy. They teach us the importance of patience, diversification, and avoiding emotional decision-making. By recognizing the cyclical nature of markets and learning from historical patterns, we can navigate downturns with greater confidence and even turn them into opportunities for growth. However, when you make these huge mistakes when investing in the stock market, you are just missing out on so much. Check out this video where I tell you more about these mistakes.